You all know we love reports on this show. Vetiva Capital Management says without a substantial decline in oil prices, inflation may remain sticky downward in the United States, thus delaying a Fed pivot. They also say expect a significant expansion in the Nigerian economy, propelled by a rebound in oil and transport services, contained in a new report that you're looking at on the screen now, a watershed moment, H2 2024 macroeconomic outlook. Ibukun Omoyeni is with a Sub-Saharan African economist with Vetiva Capital Management to discuss. Ibukun, thank you so much for joining us. Great report. I'm still reading it. Not completely done yet. So many insights which I'm going to be using going forward. So I usually start with this at the end, or rather end with this, but I'm going to start with it. What's the takeaway? Are you optimistic for the second half of the year for the global economy?
I think I'm optimistic, given the fact that global supreme pressures have eased. Although we are seeing some shocks from the shipping cost route. There are three major routes, and one of the routes is affected by drought, the Panama Canal. Suez Canal is affected by Middle East tensions. So a lot of ships have to go through the Cape of Good Hope Canal, and that increases delivery time about 10 days. But when we looked at empirical report, and empirical analysis by the IMF says that of the three shocks to global inflation, food, oil, and shipping cost has a milder impact on inflation within the CIMAC region, that is Central and Europe, Central Middle East, right, now in Africa. And what that implies is that the current shipping shock we are seeing may not have a substantial impact on the disinflation process, given the fact that shipping costs are lower than where it was in 2021 after COVID. So we think that it's not going to impact global inflation excessively. Okay.
Now, Jerome Powell, Christine Lagarde, I referenced both of them in the opening segment when we were looking at Asian markets. They were both talking about data with respect to where their respective monetary policy paths are going to. How do you think, particularly for the US, what do you think is the monetary policy path for them going forward?
Okay, so we've seen inflation decline in the EU and the UK, but in the US it's declining, but it's quite sticky, meaning it's not falling as fast as it should. We are currently at around 3.3%. And when we did our models in-house, we are seeing 2.7 to 3% by year-end. And what that implies is that we may not see a sustainable 2% path until 2025. And what that implies is that the Fed pivot may be delayed until next year if inflation does not slow down significantly. And the factor we have identified is a significant slowdown in oil prices. That's the only way we could see inflation fall faster than expected.
Now, you've got so many great charts in this report. This is looking at, I think, supply chain impact on food inflation for Sub-Saharan Africa. The report says you think things are going to ease?
So what we actually said was that we saw a link between the FAO price index and inflation in SSE. And given the fact that shipping costs have surged in recent times, we are seeing inflation tick up slightly, but for most African economies, if you look at Kenya, inflation is declining seriously because of the favorable weather conditions in that country. So a lot of domestic factors are contributing to lower inflation in major, at least the median African countries, aside from those that have shocks like Angola that just removed full subsidies. For most of the region, we expect inflation to continue to decelerate even in H2 2024.
All right. You also looked at, the report also has the monetary policy path, since you just talked about Powell and Lagarde, for the African continent, a number of African nations and their respective central banks on a hiking path. What's the forecast then for the continent then?
So going into H2, we expect a more dovish or accommodative stance, and the reason is because inflation has started to decelerate. In Mozambique, for instance, inflation is below the lower target, it's below 3%, and as a result, that's the Mozambican central bank has started to cut rates. Ghana has also cut rate by 100 bips earlier in the year. For Nigeria, we don't see them cutting rates in H2 because we still want to anchor the Naira, and even if there's going to be a slowdown in the pace of hikes, and we think that Nigeria and Angola equally needs high interest rates in order to anchor their respective currencies. But on the border range, when you look at South Africa may likely cut Q4, Q1 next year because inflation has decelerated quite well. It was flat in May compared to 5.2%. Once inflation falls to around 4.5%, we should expecting rate cut in SA. But we think that overall the outlook is quite bullish for SSE central banks.
Okay, so let me now bring you to a domestic matter that's been discussed all throughout today. Aliko Dangote at a summit or forum organized by the Manufacturers Association of Nigeria, saying that interest rates are too high and impeding growth, and we're talking about cutting Nigeria's import dependency. Also, the president, if you can pull up his quote from his inauguration day speech, we pull this back. He says interest rates need to be reduced to increase investment and consumer purchasing in ways that sustain the economy. So both President Tinubu, they both want to lower interest rates, but we can't have that. I mean, you literally just said, I want to repeat your point on it.
So I like this point because when you look at the US also, you find out that the President Trump, when he was in office, was also advocating for lower interest rates.
Right.
So it's not unusual to see the fiscal side advocate for low interest rate. But we need to see the fact that the CBN has a goal. The primary goal is price stability. And the way economics works or monetary policy works is that they are competing economic objectives. So in trying to solve one problem, you might be causing another problem elsewhere. So you find out that inflation and growth, for instance, are conflicting. So to bring down inflation, you might have to sacrifice some growth in the short term. And what we saw in February, March was unprecedented. We saw exchange rates go to as high as 1,006, 1,008. Due to the policies of the CBN to raise interest rate and make it attractive for foreign investors to buy our assets.
And the money came in.
The money came in, exchange rate appreciated.
Right
now we are at 1.5, but I tell you that if we were to follow that trajectory of 1.8 by February, we should not be at 1.5 by now. So there's significant place when it comes to FX, and that FX stability would, in the near term, also feed into growth prices, right? So you just have to look at the balance of the two, right? The central bank has to focus on hitting that FX point, and it has to do so by raising interest rates. Over time, once inflation begins to moderate, just like we see it do, we believe that probably by 2025, there will be room for rate cuts in Nigeria.
All right, so thank you for that. That segues perfectly to another chart. I just love these charts so much. You've got foreign exchange, so movements across different currencies, which is great. You got almost everything here. You got Uganda's currency, you've got Kenyan shilling, Naira, so on. So what's your forecast here? You're saying with further depreciation or appreciation against the US dollar? What's the move?
So looking into H2, we think that the return of African sovereigns into the international debt market was a positive one. Kenya was able to successfully refinance its debt in H1. That was what Ghana could not do in 2022 because of Russia-Ukraine war. And as a result, that led to a significant strengthening of its currency. If you look at the other end of that curve, you see Nigeria is the worst performer. And that's because the CBN had to devalue the currency. Not necessarily because that's what the model see, but that's because it needed to address certain structural issues, right? So as a result of that major policy, we saw the gap between the official and parallel market rates collapse. Now it's between the 2% permissible gap, which is what investors would love and smile at. And we say that even at this current level, so at 1,005, we believe the Naira is still quite undervalued.
Okay.
And when we did our modeling in-house, we found out the fair value of the Naira is around 1,060 Naira for 2024. And there are factors that could actually make it appreciate in further years, given the fact that there's a Dangote refinery coming on stream, which would strip out about 30% of our oil imports. And there's the export capacity of refined products, which could actually boost our exports. And these two factors are positive for currency over the medium term.
Fantastic. All right, so we've got a number of charts for Nigeria as well, because you also delved into what's going to affect your forecast for the second half of this year. So, okay, this is your debt service to revenue ratio. You think this is going to continue because you see that it's 2023 coming down to 64.5%. What's your forecast here? You think that's still going to ease? So
the easing, it depends a lot on revenue outturns. We saw that last year. What drove revenue up was grants and donor funding. And that's a one-off. We cannot expect that again in 2024. And of course, we will see debt service revenue remain around the 64-70% levels. But we think that the progress with at least getting revenue up by the federal government is actually commendable. For the very first time since, I think, 2018 or 2017, we are seeing the fiscal deficit to GDP at below 3%. It actually fell to 2.95% in 2023. And if we continue on this trajectory, that's very good for our fiscals. Of course, there are some worries in the near term. Of course, minimum wage, one. Number two is a rising debt servicing cost, especially the domestic debt service, given the fact that rates on treasury bills are up. So the government is borrowing at a more expensive rate from the local market. But we think that given the depth of its local market, that could actually support Nigeria from going the way of FX or going to look for commercial debts over the near term.
By the way, minimum wage without supporting productivity, in fact, with or without, it's inflationary, is it not? The raising of the minimum wage. I wanted to stress that point. I want to stress that point.
So for Nigeria, we don't find evidence that minimum wage is inflationary,
Okay.
given the fact that Nigeria is majorly structural issues.
Yeah.
So if, for advanced economies, wage growth could be linked to inflation, but we fail to find that evidence when we look at data in Nigeria context.
But if you give more people money, give people more money and they go out and spend it, isn't that demand pull?
Of course, that's why I said in terms of practice, right? A lot of things that work in America may not work in Nigeria because of the structure of the economy.
Yeah.
Now, we found out that the last time that wage was increased, that was 2019. We saw inflation fall. It started to rise when borders were closed. That's the supply shock.
Yeah.
So we found that the supply shocks have more impact on inflation than the demand shocks. So a rise in minimum wage towards it is negligible when you look at the scheme of things when it comes to inflation in Nigeria.
Balancing it out. All right, let's pull up another chart here. We've got a lot to discuss with Nigeria. I mean, there's the FX matter, there's debt sustainability. This is a sensitivity analysis of the open market price of PMS. So subsidy is still in place, right? Talk us through what's happening here.
So as at May, the open market price, we don't use landing cost, it's open market price because the MBS publishes PMS price on average in Nigeria every month. And the average for May was 760. That was because of the forced scarcity we had, the issue with labor unions clamoring for more wages. But when we took the PMS price template and we calculated what should be the price of PMS based on the current exchange rate and the current oil price, it should be around 924 Naira per litre, which is about a 20% upside to current PMS prices. And what does that mean? That means that even though we will see today a 20% increase in PMS prices, inflation would still moderate in H2 2024. Because last year we saw about 100 to 200% increase in PMS price from 200 to 500. So now that we are saying that the upside is just slim, it's about 19%, 20%, even if we see an increase in PMS price in H2, it will only cause inflation to rise for 1 month.
Okay.
For the following month, it's going to start decelerating because last year's base effect is quite high.
Right.
And we have strong indicators to see that inflation would actually moderate from probably July 2024.
I think that's our next chart is on inflation, where you say it could fall towards 28%. But yeah, there it is. So that's part of what you're talking about as far as inflation.
Exactly.
Yeah.
Yes. Well, so the reason why there's a factor is because there are many possibilities. A lot of things could happen during the course of H2. And we've looked at the fact that if PMS prices are adjusted upwards to the fair value, we think that there might just be 1 or 2 months uptick in inflation, but we think that overall inflation will still keep falling.
What about CBN? You said they deliver on its commitment to align money market rates with the MPR. Because I noticed the current window for the retail savings bond, the rates actually came down from June to July. So is that essentially what you're talking about here in terms of we're not seeing rates climbing further, or what?
Okay, so what this chart actually means is that since 2019, Nigeria has operated a differential interest rate regime such that we saw treasury bill rates fall significantly to single-digit levels, even though we had inflation at high levels, right? But what we saw again was that the MPR was not reflecting the Nigerian treasury bill market. But what we've seen since February is that there's been a significant increase in NTB rates, and the true yields on NTB is actually tallying with the MPR. All right, and the reason for bond yields falling is because, of course, looking at the last inflation report, we saw inflation moderate on a month-to-month basis for the second or third consecutive time since March, and that the market's already pricing in the fact that inflation is on the way down, so definitely yields are going to follow. That's why you're seeing bond yields on new issuances drop. So the market is also saying we believe that inflation will soon moderate. Okay. So I believe that's the reason for that.
All right, so let's get to the, you mentioned this now, you saying the Naira is undervalued, I think about 33%. So, and you're saying what, 1,060 is? 1,060. So talk us through that one more time. I think you already touched on this, but one more time.
So
people don't like this if it comes through.
There are various fundamental models that economists use to value currencies. There's the PPP, purchasing power parity. There's the fundamental exchange rate model. We use the behavioral equilibrium exchange rate model because we like the fact that it is the theoretical underpinning relates the productivity differential, inflation, interest rates, your exports. It relates a lot of factors that affect the Nigerian economy to the exchange rate. And we found out that the factors we identified, the model had a high predictive value over the exchange rate. And what we saw was that we were able to filter out cyclicality, and we found out that the fair value of the Naira is actually 1,066 Naira. The last time the Naira was undervalued by our models was in 2018. And that was the last time we saw a bit of stability, right? 2019, 2020, 2021, from 2020, because of COVID, 2020, we did not see adjustments in the Naira in tandem with the fundamental drivers of the economy. But what we are seeing now is that based on the way things are, based on our export, our import, based on all these domestic factors, the Naira should actually be around 1,000 Naira. What does this imply? This implies that the more the Naira trades further from 1,000 Naira, the more attractive the Naira is. And that was the reason why at 1,600, 1,800, when foreign investors saw that the yields on our treasury bills were very attractive, they came because they knew that 1,800 Nigerian Naira is not worth that price. And we even make bold to say that by the time domestic refining of PMS commences, especially when we're able to sort out the issues with domestically refining oil, that is, we produce our oil domestically and we refine that oil domestically, that would boost our exports significantly, that would reduce our imports drastically, and that would ease pressure on even our reserves. We will see reserves rise, right? The crude for PMS swap, we expect those things to decelerate once this comes into play. And we think that over the medium term, there's a strong reason to believe that Naira may trade below 1,000 Naira in the nearest future.
Look, we can only hope. It's a great report. Encourage everybody to go check it out. And thank you so much for coming on the show to dive deep into the weeds. Ibukun Omoyeni, Sub-Saharan Africa economist with Vetiva Capital Management. Thank you so much.